I think it's important to try and take stock of what is the outlook on credit growth going ahead for FY25. Ujjivan Small Finance Bank came out with numbers last week, but it's a good time to get in Ittira Davis, MD and CEO of the bank, to try and understand what could happen in the quarters to come. Their quarter, on a sequential basis, was flattish. On a YOY basis, I think on most counts, they did really well. NII was up 27%, PAT was up about 6% YOY. Provisions were also a bit mixed, of course, up about 25% quarter on quarter. Mr. Davis, good having you. Thanks so much for taking the time out. This is Neeraj here. Good morning. How do you sense the possibility of credit growth in FY25? Because one of the most common arguments that I see, this is for the banking space at large, not just about Ujjivan, of course, but the most common argument that I see or hear is that corporates, large, mid, small, are not necessarily depending only on banking finance for funding any kind of capex that may have. Any thoughts on this topic, sir?
Good morning, Neeraj. Thank you for having me on NDTV. I think it's a good question. We have had 2.5 years of good credit growth. I mean, all banks are doing extremely well. The whole segment is doing extremely well. So I think, the question is, how is the economy going to do from here onwards? And that will also play an important role in demand. And also the deposit creation in the market is getting a bit difficult. Liquidity is a bit tight, although RBI has been seen to, try and put some liquidity into the market. So given, I think maybe in the second quarter, we will see a lot more clarity on this post the election results. But I think, right now, the demand may be slowing in the large cap segment or the large corporates. It's also beginning to slow in the other areas, or rather the lenders are beginning to slow a little bit, even in the small lending space, the financial inclusion space, because, it's a period of consolidation. 2.5 years of growth post-COVID has been fantastic, but, you can't carry on that forever. So I think it is a consolidation phase. And once the new budget is announced and we are into the second quarter of this year, there will be a lot more clarity.
One of the feelings or one of the beliefs, aside of the technical nature of the MTM gains in bond portfolios, is that this large RBI dividend gives more ammo to the government to fund capex. And largely it's been public capex or government-driven capex that has been the driving force behind all the capex spends in the country thus far. The belief is that private sector, except in fits and starts, hasn't quite participated. Does this large dividend give some confidence that capex spends will continue, even if in the near term, until the US elections are out of the way, if at all that is a factor, that private capex doesn't come back in a hurry?
No, I think there's a lot of hope placed on this huge dividend with the government, so that some spending will start and move in that direction. And hopefully, by the fourth quarter, we are hoping that interest rates will also begin to start weakening and decline. So once that happens, some demand will come back through that process. But yes, most importantly, this dividend which the government has received is something that we are all hoping, as participants in the market, that some of that will be spent in capital development, in sort of other outlays. There's been also talk about, increasing the outlay on artificial intelligence and so many other projects which are there. So any of those projects that take off in the second quarter and third quarter will help the, the spend in the markets.
Okay. What about your own numbers, sir? The NI numbers, etc., all looked okay. Was it provisioning or higher provisioning YOY that hit the bottom line numbers? And what's the reason for the same? And what's the outlook going ahead, particularly on the provisioning and the asset quality? I'll come to growth in a bit, of course.
Right. I think good questions. And, as I mentioned, in the other part of the overall discussion we had, there's been 2.5 years of big growth, and there's a lot of credit which has come into the market, and a lot of borrowers. So I think we are seeing a little bit of sort of not pent-up demand. It's the excess supply which has come into the market, which is now beginning to rear its head, and there is a bit of concern in credit quality, and that is being seen. Some states we are seeing that people are looking at rescheduling or government support, and therefore repayments have slowed down. In other places, there's been excess supply and over leveraging has taken place. So that's also coming to the forefront. So like in this business is based on cycles, and this 2.5 years, this is the consolidation cycle, and I think the whole industry has to be prepared for it, especially in the financial inclusion space. And those who are prepared for it will be able to, take it through in the next 6 to 12 months, because we have to see the effect of this wear out, and I think it's an important part of the cycle that we are looking at.
Got it. For your client set in particular, Mr. Davis, is there any kind of, how do you say, concern around maintaining the level of asset quality that you would have? Are there some reasons why, either regulatory or otherwise, that you might go slow in either because regulation is saying XYZ, or maintaining asset quality might be more important than growth, if you will, in the balance that I'm talking about? Can you give us some color there, sir?
Absolutely. I think maintaining asset quality in a bank and in a financial institution is the foremost important thing that we have to look at. And we have all learned that from what happened during COVID and a couple of other crises before that. So yes, that is going to be our forefront. Now, fortunately for us, we are operational in 26 states, and in no state we have exposure more than 15%. And that spread, that diversification helps us a great deal in trying to slow down in some areas where there is an issue which we need to address. And, we can continue business as usual in other areas which are doing well. So I think that advantage is available to us and others who may be concentrated in certain areas. If the area is doing well, great. If the area is having problems, they'll have to address it. So I think this is something that the industry has to take into account, and we have taken that into account, and we have planned for this year based on that feedback. In fact, our guidance on provisioning for this year is a little higher than last year, and that is based on what we are expecting the market to do during the current financial year.
It's not, well, technically what you're guiding to also in FY25 on the margin front, Mr. Davis, is not moderation, but if I just look at the pure play numbers, what you did currently 9.4 versus what you guided for FY25, 9%, you would say maintenance of margins, or would you say that no, there is a bit of a moderation that you're guiding to?
The margins, it's a question of how we also manage internal liquidity and other ratios and things like that. So, we are expecting the interest rates to stay high at these rates till about the fourth quarter. So there's not going to be any benefit from a downward turning interest rate curve, which will definitely come in the next financial year. So for this financial year, the guidance of 9% has been based on continuing where we are, trying to hold on to the current interest rates on the term deposits and other and CASA, and building the CASA a little bit. We are at 26% on the CASA. We'd like to see that move towards 30%. And as that moves towards 30%, we'll be able to benefit from that on the NIM front, because that will reduce the burden of the term deposit interest. So it's a question of managing all these ratios from which we are able to see NIMs play out to 9%. So all in all, I think, that is not going to be an issue. It'll allow us to build in some capacity to take care of the additional credit requirements.
Mm-hmm. Okay. One final word, sir. I heard you mention at the start of this conversation that a lot of things hinge on the performance of the economy. All global forums, global investors, etc., all believe that the numbers, I mean, for them, India relative to the rest of the world is good growth. I'm just trying to understand related to what India has done in the last 2-3 years. The earnings growth has been stupendous, but we've had 4 years of very strong earnings growth for India Inc. at large. Do you think we can do an encore on GDP and earnings, or could there be a bit of a moderation because of a number of things, including the fact that the election code of conduct takes away some of the business decisions for the first quarter at the very least?
Yeah, some moderation may happen this year, but that moderation doesn't mean that we are slowing down overall. We are still doing much better than other countries, and in the G20 itself, we are doing very well. So I think moderation is not a bad thing by itself, but the level of moderation is important. A little bit here and there adjustments are often welcome, as one step backwards perhaps before taking two steps forward. And I think that is from time to time we have to look at that and see how to manage that situation.
Got it. Mr. Davies, great talking to you. Thanks so much for being with us and giving us your thoughts. Really appreciate your time.
No, thank you very much, Neil.